When a business is started, the owners of a company need to determine what form it should take. Should it be a sole proprietorship, a partnership, or a corporation? We've already discussed the difference between the three. However, let's do a little more detailed analysis of the corporate form of an organization. Corporations can be nonprofit or profit organizations. When we say nonprofit, the driving force for the organization is not to make a profit, but more to do a social good. A for-profit organization intends to try to make as much of a profit as possible. Now, most for-profit organizations will either be publicly held or privately held. A publicly held corporation is one of those that can easily change its ownership by the sale of stock on the public stock exchanges. A privately held corporation, while it may sell stock to its stockholders, does not easily change its ownership, since there are several restrictions in terms of the sale and purchase of privately held corporate stock. Some of the characteristics of corporations is that there are definite advantages and disadvantages. When we look at corporate stock, one of the best parts of a corporate stock is that it has a separate legal existence, in that a corporation has all the rights and duties as an individual would. The nice thing about this is that we can keep the individual stockholders separate from the corporation so that we have the ability to limit their liability. The liability or the amount of risk that an owner takes on in a corporate environment is their investment. Now, with most corporations, they have the ability to sell their stock. It's far easier to sell their stock on the public stock exchanges. However, even in a privately held company, they can sell their stock as long as they follow the rules and regulations set forth for privately held corporations. A corporation can also generate additional capital. Remember, in earlier lectures we talked about capital as the investment of the owners. So when we're looking for capital, we can have more capital by selling additional stock. Now, a corporation is independent of its individual owners, so it has a continuous life. The stockholders can come and go as they own the stock, but the corporation continues to exist. Because there is a separation between the stockholders and the corporation, many corporations are managed by management that are not necessarily the owners of the company. Now, there are situations where the owners of the company will be within the management ranks. However, it is not a requirement for management to be an owner. As a separate entity, corporations are regulated in various areas by the government. They are subject to laws that are done by the federal government and the state government, but also because they are entities that are where the ownership is being sold, they are subject to the SEC as well as whatever stock exchange that they're selling their stock on. And finally, a corporation as a separate entity has to pay taxes. So what ends up happening is that a corporation will be paying taxes on its taxable income. When a distribution of capital goes to the shareholders, the proceeds of the distribution, known as dividends, ends up being taxed at the individual level. Therefore, what we run into is a double taxation situation when we're trying to move profits from a corporation to the shareholders. That is definitely one of the biggest negatives of having a corporation as your form of business. Most organizations have a specific structure where the stockholders are the owners of the business and then they hire or obtain leadership by the chairman of the board and the board of directors. Now, the chairman of the board and the board of directors do not necessarily have to be day to day managers. In fact, most large organizations will have outside people acting in the role of chairman of the board and board of directors because they set the long term vision of the corporation. They give the information to the president and the chief executive officer, whose job is to implement the goals and objectives of the board of directors. The president and the chief executive, the officers, have their people below them who could be vice presidents or various other management level people, and their job is to work with the company on a day-to-day basis. Companies may decide to use another form of business organization, such as limited partnerships, limited liability partnerships, limited liability companies, and S corporations. All four of these forms of organization, for the most part, intend to try to minimize the liability of the owners while still trying to pass the profits of the business to the owners without the double taxation. Limited partnerships protect the partners in that there are two classes of partners, the limited partners and the general partners, where the limited partners' risk extends only to their investment. Limited liability partnerships and limited liability companies are set up to protect the owners of the company as if they're corporations, however, be able to flow through the profits of the company to the owners without the issue of double taxation as we would run into with a normal corporation. The final entity, an S corporation, is a corporation for small businesses. There is no double taxation since the owners of the company are treated as the individuals while they still get the liability protection of a corporation. The biggest limitation of an S corporation is that they can have no more than 75 shareholders, and it's also more difficult to buy and sell their stock. So what's the steps to form a corporation? In most states, all you have to do to file a corporation is to file an application with the Secretary of State. In most states, they would require you to develop an articles of incorporation and the bylaws of the corporation to be filed with your application for incorporation. Once your application is accepted, the state would grant a charter for your corporation. Of course, one of the things that you want to make sure you do is when you pick where to incorporate your business, you choose a state that's more favorable for your type of business. Corporations that engage in commerce between states must obtain a license from each state in which they do business. So once that's done, you're all set to become a corporation. Your stockholders have various rights. If your stockholder is a general shareholder that owns common stock, they have a right to vote. Their vote is in the same proportion as the number of shares they have compared to the total outstanding shares that have been issued. As a stockholder, they have the right to share in the corporate earnings through the receipt of dividends. Remember, we mentioned earlier, though, that some corporations make the decision not to issue dividends because they would rather keep the proceeds and use the potential dividends as capital for other investments within the company. In the event that the company issues additional stock in the form of dividends or some other means, shareholders are guaranteed that they're not going to lose their ownership percentage when that stock is issued. And then finally, in the event that the business goes out of business, The shareholders have the right to receive parts of the company or the value of the company as dissolution occurs after the creditors have been paid.